Hey there, I'm Drew Nichols here with LTC Tree, and my cousin slash business partner here at LTC Tree, Derek Wilkins, and I. Today, we're going to talk to you about qualified long-term care annuities. Do they exist? If so, what's on the market? And we're going to kind of go through the pros and cons and some of the approaches that you might want to take if you're thinking about using some qualified money for a long-term care annuity. So, Derek, let's jump into the topic.
Yeah. Hey guys. Yeah. Thanks for joining us today. Again, like Drew said, we're going to talk about qualified fixed index annuities. And Drew, maybe you want to start with that story, the gentleman in Texas
Yep. So we had
that
a
we had
client.
just had the
Yep.
conversation with.
Yeah, we had a client in Texas that kind of prompted us to make this video because we see all different kinds of situations, but essentially he was very adamant about using some qualified funds. He had investments in multiple places, a lot in index funds, which we recommend, and some things in bonds and so forth. And so the question that he posed to us on our Zoom call just a bit ago was, why would I do a long-term care annuity versus just buying and holding a 10-year treasury, which is about a 5% return? You don't have to worry about the value of the bond changing over 10 years if you're holding it to maturity. So let's dive into someone who may be kind of in the same situation, has some qualified funds, and talk about how things can possibly work out one way versus the other.
Yeah. Yeah. So that kind of brings me to a client that I had. It was maybe right after the dot-com bubble. It was a client who, same situation. At the time, he was in his early 70s. And once you get into your 70s, you don't have the time horizon. So he wanted to get a return on his money, but didn't want to put it to the risk of the market. So back in 2004, the fixed rate market was probably 4 or 5%. So he could have gotten something similar. But what we found him was we put him in equity index annuity because it gave him a shot at a much higher return than 5%. And so if you think back to after the dot-com bubble, we had 9/11 and the market was down 2002, 2003. Then it started going back up a little bit, 2004. That's when he decided to put the money in. And what an equity index annuity is, you're not directly invested in the market. You're indirectly indexed to these funds. And I think at the time it was the S&P 500. And so he had a good market. So that return for that 1 year, because he hit it when the market was going up, as opposed to getting a 5% return, he got a 32% return in 1 year just because he hit it when the timing was right. So these annuities, they give you a shot at getting a high return. Now, I wouldn't expect you to get a 30% return every year by any stretch, but over the past 10 years, there's several that we have that have averaged probably 11, 12% per year. So it could go the other way. Maybe you get a 0% return, but you're never going to lose money. But at the same time, it gives you a shot at getting a double-digit return.
Yeah, and almost every time I run into one of these cases where someone wants to do qualified funds specifically, so that would be an IRA, 401k, that kind of thing. If they want to roll that into one of these products, a common question that comes up, and we just talked about it with this gentleman in Texas, is that can I create an account for my spouse and myself, specifically around the long-term care need? What if she needs it? What if I need it? So forth, with the qualified funds? And the answer is no. So let's talk about that for a minute.
Yeah. So, when you're using qualified funds, commonly known just like an IRA account, you can't commingle one another on individual retirement accounts. So in that case, you'd have to set up an account for each husband and wife, assuming that they both had IRAs. Now, you can do a joint account if it's after tax money. So non-qualified accounts, you can do joint ownership, but qualified funds, it has to be individual owners.
Yeah. So what we're going to do in his case is look at maybe just splitting the premium in half, and then they each get their own bucket with their own IRA money. Um, okay, that brings us to the other piece. Anybody who's looking at qualified long-term care annuities probably should be looking at a hybrid long-term care plan. And let's talk about the options or lack thereof when it comes to buying a hybrid long-term care insurance plan with qualified money.
Yeah. So there's one company in particular that will still take qualified money for spouses on their long-term care plan. It's going to be a watered down long-term care policy compared to like a traditional long-term care policy or a true hybrid policy. But the benefit of it is it's easier to qualify for, much easier to qualify for. So if you have health issues and you feel like, you know what, I have diabetes, I'm overweight, I might use this within the next 5 years, then that particular product might be a good fit for you. However, if you feel like, you know what, I have good health, I'm on just a couple medications, my parents lived into their 80s and 90s, I might not use this for 15, 20, 25 years, then with time on your side, that's where the qualified or non-qualified index annuities could be a good fit, because who knows what the market's going to do in the next 5 years. But over the next 10, 20 years, the odds are it's going to be a lot higher than it is right now. And if that's the case, you'll have basically created a long-term care or just retirement checking account that you can use, spend on anything you want. So it's not an insurance policy, it's actually your cash money that you can spend on anything and all things retirement.
Yeah, and I mean, even if you bought one of these, it's a 10-year contract. So, it's like we told that gentleman, the downside, one of the biggest downsides to this is your liquidity over 10 years. Consider it locked up. So let's say, for example, you buy one of these products, and in the first couple of years, the market takes a big dip. You lose nothing, which is nice. So you've got that baseline to build back from should the market spring back. So like you say, for someone in their 60s or 70s, this is a great way to get some participation in the market without taking the risk of downside, losses, which could be substantial.
Yeah,
If this AI hype boom falls apart, it could be a big crash,
it could, yeah. So, but you bring up a good point. And again, this is not something you want to have all your money in there, but if you have money that you're not going to really need, and you can sacrifice the liquidity in the first 10 years, your example, like if you put 100,000 in, it's in like a regular fund, say you have a 50% correction, now you're down to 50,000. What percentage do you have to get that next year to just get back to even? It's not 50%, you got to get 100% return. Versus these products, if you can stomach the fact that you can only take out 10% per year in the first 10 years, if you had a big correction, that 100K is still 100K at the end of that year.
Yep. And you do pay some fees for that, and a good broker is going to highlight those fees up front rather than try to hide them. So we're always very transparent about the fees that come with these and what you get for those fees, because you get a higher participation rate in the markets, things like that. So if somebody's interested in learning a little bit more specific to their situation, because there's multiple companies that do these plans, multiple insurers, our secret sauce is we do a side-by-side comparison of multiple ones. We find what we think is the best option for our client.
Yeah. So if you'd like your side-by-side comparison on any of these index annuities or the fixed annuities, fill out the form below on our site or call us. We're happy to discuss, and you can bounce questions off of us, and then we're happy to send you actual hard copy of the information side by side.
Yeah, so thanks for watching. If you haven't already, please subscribe to our channel. We're just getting it started, and we're releasing new content every week or two. And thanks for watching LTC Trees video. Talk to you later, Derek.
All right, see you guys. Thanks.